Thanks
Great.
everyone for joining. And it's nice to be here. Nice to see so many participants. You can all hear me? Hello?
Yeah, I can hear you, and I believe others can too.
Okay, great. Perfect. Okay, so I'm just, are you going to start the recording, Bishop?
Yeah, I've started already.
Okay, great. So I'm just going to pull this up on my screen here for the purpose of the YouTube so that everyone can see. These are the FIB settings that our friend Michael uses, and we all may or may not know them. If you don't know them, it doesn't matter. They are covered lightly in other YouTubes that SimplyPips have posted, but these are the settings you can go back to. You can all see there on my screen. You can ask questions later of what they all mean, but these are the settings that I use and most other ICT traders would also use. Okay, so to kick things off, this particular, as you know, we've followed the order flow here and we've marked up a source, we've marked up a breaker, and you can see the red box is our first order block that was inside of the breaker block. So the two red lines on my chart here that I've marked up, I'm just going to go ahead and make sure that you can see my mouse over here. So this red line indicates our source at the top, and you can see the red order block over here that I've created, and this bottom red line. Now, if you followed the other part videos and you're up to date, then this won't be a problem for you. For all the newbies, you guys should go and check out all those videos. They're very helpful. But to get straight into it, all I need to do here is that because we have already broken and created our breaker, we just need to pull down our fibs from the top of the wick of the 4-hour time frame to the candle that broke the breaker to create the breaker. So you can see here, this here was our last order block before the source, and it was broken down, and this is the wick, and that is the wick of the source. So I've pulled my fibs from the top of the source to the bottom of the wick of the candle that broke. Now you can see here, price then retraced back up into our sweet zone. So our sweet zone, if you look on my fibs, is the 79% between the 62%, and in the midpoint of that is our OTE level. And basically it's come right up into our OTE level. Now you can also see that this order block that was created before the down move, before the break and making the breaker, you can see that price traded straight back up into this order block. And you can see here the price is now rejecting. So having followed the IOF strategy, here we can clearly see that we are now looking for sells. So when price comes back into here, our sweet zone, 79%, OTE, and 62% is where we want to look for taking a trade. Now, it depends on what time frame you are going to be trading from and what your trading plan is. So if you use a 30 pip stop loss or a 50 pip stop loss, or if you're looking for a swing or an intraday trade, this is the area where you would want to look for a sell. So if we look now at a closer picture on the 1-hour chart, having marked up on the 4-hour chart our source, our breaker, here is the 1-hour candle break over here at the bottom. So if I take my crosshairs here, you can see that this here is the last candle, the order block before the source on the 1-hour. And over here, this is the candle that closed below the breaker of the 1-hour. So here is our breaker on the 1-hour. Let me just highlight this so you all can see it. And you can see that price closed right there on that order block. And I've highlighted just to make things easier for us. So if you can see, when I pull my fibs down from the source on the 1-hour to the bottom of the breaker, the candle that closed outside of the breaker, you can see again that price retraced back into our sweet zone. it didn't quite hit our OTE and our 79%, but we need to remember that this is a zone that we have marked up for a potential sell. And we can already see that price is respecting this order block here and not closing outside of it. So it depends again on your trading plan. But if you were to take a trade at the top of this order block here and using the top of the 79%, that is 71 pips. For me, that is too high. So what I will do is I'll go down to the 30-minute chart, having marked up all of that on the 4-hour chart, and I will look for a better entry, knowing to look for a bearish move. So if I continue here, price is still respecting the red box, which is our order block. And if we continue down over here, we will see that price again rejected off this level. And if we're using the order flow and our breaker, now this being a 30-minute chart, we can see over here that this here is the breaker on the 30-minute chart. Okay. Now, if we take our fibs and we pull it, keep in mind that this is a lower time frame. So the wicks have less volume than a higher time frame volume. So you want to use the bodies on the lower time frames than you were on the 4-hour. So I've pulled my fibs from the top of these candles to the breaker. And this candle here on the 30-minute is the breaker, because this was the last up move before the down. You can see there, if you were to say that this was the 30-minute source inside the 4-hour order block, then price came up to our OTE 79% and traced down again. So let's just take a look here. If we were to place a sell limit on exactly the OTE, our optimal trade entry, and if you include broker spread like you should, you can see that that's 30 pips. And if we measure it down, well, there's already 140, 150, 170, and as the move goes. Okay, so you can see that the lower the time frame you use, the better the entry is. So going back to our 4-hour, let me just explain again what I did here. We've marked up our source. We've marked up our breaker block after it created the breaker block. And when price retraced, we already have an order block inside of our breaker block. Now, remember in previous videos, we've said that when we have a source and a breaker, and sometimes even an order block intersecting, we have a very good chance of a high probability trade. So you will be looking for sells here. So if you were to take a swing on this, you could even go so far as to pull your fibs down from the top of the source to the bottom of the breaking candle and put your entry for a limit on the OTE and put it above over here if you are swing trading, but that is too high. So you need to go down to the low time frame on a 30-minute, and like you see here, we've basically done the same thing. Now, it's important to remember that if you don't mark up which direction the order flow is going to continue in, it's going to be very difficult to catch a good trade. So it's important to mark up on the 4-hour chart where the directional bias is going to be heading for the next day or two or the week. So it's important to do this first before you can find yourself an entry either on the 1-hour using the fibs or the 30-minute using the fibs. So it's important to also remember that when we are doing this on the 4-hour, the 1-hour, or the 30-minute chart, we always use the candle that is broken or created the breaker block. The bodies are important on the 30-minute chart and the 15-minute chart. And if you're going to the higher time frames, I've tested and back tested quite a bit of months of data on different pairs. And I've found that if you're going to use the 1-hour and the 4-hour, You need to use the wicks of the source and the breaking candle for better entry, and then using the lower time frames to get a precise, almost sniper entry every time. So you can basically do this on any pair. So here's another pair. This is AJ. So let's just look at a recent low over here, and we can start from fresh. So let's just have a look over here. So let's start from the beginning. We know that we need to mark this candle over here as our source. And I'm just going to do it the long way so you can all see that there's no strange pictures and it's all legitimate. So here is our source, and we mark this one up over here as our breaker, because that's the candle that was green and that was created before the down move. And we mark that up as yellow. So you can see there's my source, there's my breaker. And what I will do over here is just take my fibs on the 4 hour from the bottom of the source wick to the candle, the 4 hour candle that broke and created the breaker. Because remember, we don't count wicks, we count candles that close outside of the candle over there. So here is our breaker created by this candle. And as you can see, if I drag my fibs across here, when price rallied up, created the breaker and retraced back down, retraced back right into our sweet spot, our 62%, our OTE, and our 79%. Now that is the zone we like to trade in. And it depends on how you want to look at the strategy, but generally you want to either split your positions and take one at an early entry, say the 62% and the OTE. And I generally don't like to take trades unless it's a swing trade with a stop loss of more than 30 pips. So if we measure this over here from the OTE to the bottom of the source, that is a 50 pip move. So that may or may not be in your own personal trading plan, but I personally on this trade would have used about a 25 pip stop loss. Now, why would I have used a 25 pip stop loss? Well, I know that over here, this is a 4 hour order block. So if I mark this up over here, that is a 4 hour order block right there. And we can see that if I just change this to red, so you can identify that as an order block. Price basically tapped this order block and bounced straight up. So there's multiple levels of confirmation to take this trade. So we have a breaker, we have a source, we have an order block inside the source, we have the big move up, and then price retraced back into this order block. And I've pulled my source fibs from the wick to the breaking candle, and there is my confirmation right there. I need to take that trade. So let's just, for the sake of it, go down to the 1 hour time frame of AUD JPY. And if we look over here, that is the 21st of April. So if we go to the 21st of April, which is that move over here, we can do the same. So we already know that that is the source over there. And on the 1 hour chart, right here, we have our breaker. So we mark that up, and that is the breaker. So we already know that's the source on the 4 hour. Here is the 1 hour breaker. And if I pull my fibs, remember, from the wick of the source to the candle that broke the source and price retraced down into our OTE, our sweet spot, 62 OTE and 79%. And as you can see, price then rallied up. So it's important to know all the time, every time you make a trade, use your markups on your higher time frames to know directional bias. If you don't know the directional bias, well, you might still get good trades, but you won't get the high risk reward ratio trades, 1 to 3, 1 to 5, 1 to 10, 1 to 20. You're not going to get those trades unless you know your directional bias, where price is going. So that is why it's important to use the higher time frames and then go to the lower time frames to get a good entry. Okay. There's one more thing I want to cover, and that is the 15-minute setup, where you can take trades based on the directional bias of the chart. So if I go here to my 4-hour, and let's say we just use this recent high here on this pair. So this area here is the recent high for this down move. I will now show you how to use the fibs on the 15-minute chart so that you can take trades either if you're a sculptor or if you want to add to a already running position. So if we look over here, here is the peak high of that 4-hour chart. Now, it's quite easy to look at it and say, okay, I'm going to take a trade, but let's just do it using our fibs. So let's see where our source is, which is right there on the 15-minute chart. That is our source. And we need to know where our source is so that we know that that's the top peak formation high that was created, or whatever you want to call it. Some like to say support or resistance, but those are retail concepts. So that is our source on the 4-hour chart. And if we use our fibs now, we need to say that over here is market structure. Market structure. So price is bouncing off there, bouncing off there, bouncing off there, and it was broken. So when price breaks market structure, we need to use the fibs on the order block that broke market structure. So here is the order block. And again, we use the candle bodies and not the candle wicks because we are using the 15-minute time frame. So let's just pull down our fibs from body to body for a bearish move, because we know our directional bias is bearish. So we are looking for sells. And as you can see here, when price broke the market structure, price then started to retrace. And where did it retrace into? Our sweet spot. Now, if you're using, depending on what strategy, a sculptor, or if you had already taken a trade here based on the 4-hour order flow, well, then now you want to either sculpt or add to your position. You would use very small stop losses. So if you were entered at the OTE level, you can see that the top of this is only 5 pips, but you would put your stop loss around here so that you wouldn't want price to retrace back up. And as you can see, that is only 15 or so, 14.5 pips. So that is a very good entry. Now let's just follow the movement down over here, and we can still look for bearish moves because we know our directional bias is bearish. So we can see again here that here is market structure, and here is the order block right there that broke market structure. So what do we need to do? We need to take our fibs and place it at the order block and pull it to the bottom of the correction that had started. And as you can see, we didn't get an entry right there because price didn't retrace back up. But if you took this entry, you would still be in the trade. So that's fine. We follow the movement down now, and we look for the next break in market structure. So here you can see that price is maintaining this level right here. And this is the last order block when market structure was broken. So we take our fibs from the body of the candle to the bodies of the retracement. And as you can see, price retraced back up into our OTE level. And if you only take trades based on the OTE, you can put your stop loss above the order block on the 15-minute. So in this case, it was 25 pips. But if you are adding to your position, you will have little to no drawdown once the trade starts running. And again, let's just follow the directional bias. So we take our market structure right here. Here's our market structure. So these were the lows over here. And this order block over here on this 15-minute, right there, from the bodies to the bodies. And you can see price retraced back down into our OTE, and we would have been taken in for the ride. Now, it's important to know that when do I stop selling? Well, if you look at the 4-hour chart, you need to know where your previous source was. So if you see here, here's our previous source. So at some point, you would stop selling because you know there would be some reaction at that level. And that is how I personally do my 15-minute entries or adding to positions. And anyone can do this. It's not difficult. All you need to do is drag it from the bodies on the 15-minute candle on the order block to the lows. And you won't get an entry every time, but when price retraces back up, you will get an entry if you know your directional bias. I personally, like I said, use 30 pip stop loss on my own trades. And just so you're all aware, I personally also look for about 5 or so confirmations or reasons to take a trade. So I'll just show you here quickly some of them that we've covered. So you can see that if we mark up our order blocks on the weekly time frame, the daily time frame, and the 4-hour time frame to know our bearish or bullish bias, we use our 4-hour source, our breaker block, our 4-hour market structure with the bullish or bearish order flow. And I think we have covered some divergence in previous videos, lightly touched on it. And I would use a fib retracement as another level of confirmation. Now, these other things I use also, but we haven't covered them yet, so it's irrelevant for this video. But you can see that at a minimum, I like to use 5 reasons to take a trade. So if someone asks me, why did I enter there? Well, I can give them 5 reasons as to why I entered a trade at the level I entered the trade. And you can see that this happens 80% of the time. You will be making a trade and be correct. There will be times when you enter a trade and you lose 20 other % of the time. But if your risk reward ratio is high, then you won't be losing, you will be making money because your wins are more than your losses. Bishop, would you like to say anything?
Yes, I would like to ask you to kindly expatiate a little bit more on the 15 minutes. Now, for the purpose of a recap, it seems like the most important thing here is first getting your directional bias.
Correct.
Yeah. Then after getting your directional bias, you've just showed us 2 ways we could use our FIBs. But before then, you mentioned that if we're using our FIBs on the higher time frames, we should consider the wicks, right? Because the wicks have volume in them.
Correct.
And however, if we're drawing our FIBs on, let's say, 30 minutes, 15, and if you want to go down to 5, whatever the case, we should use the bodies of the candles.
Correct.
Now, you mentioned something subtly that I want you to expatiate on, and that is having an OB inside a source or a breaker, right?
Yes.
I know,
okay,
I know
sure.
we touched on it briefly, right? So I want you to clarify that area, open our eyes more to it. Then secondly, the way we use our FIBs on the H4 or higher time frame is different from the way it's used on the 15 minutes. So on the H4, you seem to be drawing your FIBs from the source to the candle that created the breakout block. Whereas on the 15 minutes, you draw it from the breaker, or rather the
15-minute order block.
The 15 minutes order block responsible for the break, right? So I actually want you to clear up those three parts: OB inside the source and the breaker, and what is the difference between using your fib on the higher time frame and the fib on the 15 minutes.
Okay, sure. So if we look here at this particular pair, that we can say inside this box over here, I have my recent high that was created. So if we go down to the 15-minute and we look at that zone, we know that our directional bias is bearish. So over here, we have already marked up that this was the peak formation high over here. And our first break in market structure occurred over here, okay? And it's important, I don't know if I mentioned it just now when I was saying all this, but it's important to know that you use the bodies of the 15-minute order block, and it is the candle that is responsible for the break in market structure. So if you look here, I place my fibs directly on the 15-minute order block that is responsible for the break in market structure. Here, right, this red line represents the break in our market structure. Correct.
Yeah, so Darren, what the difference here now is that on the higher time frame, we would have considered the source at the peak formation high and the candle responsible for the breaker block. However, on the 15 minutes, we would have to spot out the market structure.
Correct.
Then we draw our fib from the body of the order block responsible for the break in market structure. Am I right?
100%.
All right.
So if we continue here, you can see it will happen again. So here is our market structure on the 15-minute chart. So here is our previous lows, and here is the order block that broke the market structure. So you can see that that is the body. So I'll take my fibs from the top to the retracement. So this was the retracement, but you can see it did not retrace back into our sweet spot. So we did not get an entry over there, which is fine. It's no problem. So then we just do it again. We wait. We know that our directional bias is bearish. And here is our next break in market structure. Right here. So it's always the candle that's responsible for the break in market structure. The order block, sorry, not the candle, the order block. Let me just clear that up. It's the order block responsible for the break in market structure. So if you want to use these lows as your market structure, you pull your fibs from the body of the 15-minute to the body of the bottom where price retraced to, and that is our OTE 79%, 62% sweet spot. And it's important, Bishop, also that I said just now that we need to know on the 4-hour where our source is. So here is our previous source where we had traded to. So if we mark that up across and we look at the 15-minute, we will know when to stop taking sells.
Yeah, basically because we trade from source to source, right?
Yes. So it's possible that the institutional order flow will change once we get potentially to a source and a new breaker on the 4-hour is created. So we're using the 15-minute basically to scalp. We're not taking 100 pips off 15-minute time frames. We're taking, 20, 30, 40 maybe if you're lucky. Or maybe you do catch the top of the trend and you run it. But essentially, the lower the time frame, you're either looking for a sniper entry or you're taking scalps and retracements. So that is what we're using the 15-minute for. So like I said, the 4-hour, we are using the wicks because even though the wick has price volume, the 1-hour has price volume. The 30-minute and the 15-minute have less price volume the lower the time frame you go. So you want to include it on the higher time frames, and on the lower time frames, the 15 and the 30, you would want to use it as the bodies, only the bodies. You can still do this on the 5-minute, but I personally don't trade the 5-minute, but the same would apply. On the 5-minute, you would use the bodies of the 5-minute. Did that cover everything, Bishop?
Yeah, so great. Basically, it means we love retracements then. When retracements come, we know they're giving us another entry, right? So what I see is that sometimes when retracements are coming, we get so scared and jump out of our trades. And from here, I can see that retracements gives us a reason to go in for the trade again. I think, which pair was it? Apart from UCAD, was there any other pair that was traded this week again? I'm trying to remember. Maybe we could do this on just one more pair.
Pick a pair. Let's take a look.
Yeah. Someone drop a pair in the chat box. So do this one more time and call it a wrap tonight. Someone
EU.
said EU.
So the same would apply on EU. So if we want to mark up our retracements, all we need to do is we look over here for our breaker and we mark it up. So this we wouldn't have known is the source. So we would have thought that this is the source if we don't know this price data to occur afterwards. Okay, so it's important to know you can only see current price data. So although we're seeing this now in hindsight, it's not so difficult, or not so easy rather, to see it once price is live. So on the 4-hour, this is our order block we are looking for when price breaks it. So you can see that price went up and only recently broke it. So are you asking to see FIBs set up on EU or on the lower time frames, or what are we looking for on EU? Bishop, do you want to see like a 1-hour or something?
Yeah, just the FIB setups. How would write up our FIBs? I think we have the breaker block a little bit higher above that point. Don't you think so?
Yes, I'm just saying that this price line here, this gray line, we wouldn't have known this price data until it had occurred. We only see it now in hindsight.
Yeah, true.
So let's just say that this is a 1-hour time frame. Okay. Now, it's easier, like I said, to see it in hindsight. But here would have been our breaker we were looking at because price hadn't come to this level yet. So we were waiting on the 1-hour for this 1-hour order block to be broken. And you can see it was broken there.
Yeah.
Okay. So let's take our fibs from the top of the source to the bottom of the breaking candle. And as you can see, we haven't gotten an entry yet, but you can see that price potentially will return to that level. But let's just say this, for instance, that if we move and say that this here, let's just zoom in here. that this order block here was the 1 hour source, because this line represents this gray line here would represent where we thought the source was on the 1 hour. Okay, so we don't know on the right side of this gray line what price is going to do. So we are estimating that this is going to be our breaker. So let's take it from the source to the breaking candle. And if we were to enter a trade, once price broke, you can see that it did tap our sweet spot, and it doesn't happen every time, but you would have been taken into a trade. And let's just mark up our order flow. Let's just do a bullish one here quickly, because we had already made a bottom. So we don't know that that is the high yet. Price can still go up, but we do know over here that price had bottomed. So there is our breaker on our 1 hour. This is our 4 hour breaker, sorry. So there's our 4 hour breaker. And we go down to the 1 hour at that same price level. We want to look for an entry now. So if we take the 1 hour, here is our source. There's our breaker. And price never gave us an entry. But you can see that that is how I would mark up the 4 hour breaker. And there's our OTE, 62%, 79%. Now we didn't get an entry on that one, but I can give you another example on EU that recently happened. If we look at the 4 hour chart over here, we'll notice that over here was the breaker. There's our breaker right there. Price traded up, it broke down. So we take our fibs from the 4 hour to the breaking candle. So here's our source wick to the wick of the candle that created the breaker. And it didn't come in there, but you can see that it retested it. Now it's not going to give you OTE 62%, 79% every time, because we are not only using the fibs as an entry, we are just using it as a tool. So there's unfortunately nothing I can tell you that will make it 100% every time. We are only using the OTE as an entry. So any questions? I think you, Bishop, you said that you wanted to ask me about the order blocks inside the source inside.
Yeah.
Okay. So that's obviously when we have a sweet zone. So again, we want to look at EU. So here is EU, right? So this is a good example, actually, now that we're on EU. So we've marked up our breaker right there because price broke out. So this is our source. So there is our source. And inside our source, we will see that there's an order block. Here is the order block. Right there, created. Make it red. So inside our breaker, inside our source is an order block created.
Final low.
Thanks. So inside there, we have triple confirmation that when price comes down to that level, we will expect a high bounce. And we can also see that on this level, there is a fair value gap right there between these two pink lines.
Exactly.
If we zoom in a bit there, you will see that right there is a fair value gap. So not only do we have a source, a breaker, and an order block all intersecting with each other, we also have a fair value gap. So when price
Four
goes up,
confirmations.
yeah, and when we go down, you can see that price wicks inside of it and then takes off because we know that our directional bias is bullish. So there is the wick right there. And if you enter inside there, I personally trade limits. Not everyone might want to trade limits, but this is a 4 hour. You can see that that is very small stop loss that you would have to use. Even if you were to use a stop loss of, let's say, below of 30, I use 30. So 30 pips is not a lot, but you're catching high risk reward ratio. So it's always important to know that when price is imbalanced with a fair value gap, and there's an order block, and there's a source, and there's a breaker, and there's a fair value gap, I think that we've just said that actually, sorry, we can expect that price bouncing off that, as you can see here, almost to the pip with very limited drawdown if you were to take a trade over here.
All right, so last question from me before we give room for any other person to ask a question. So how do you frame out your take profits?
How do I frame up my take profits?
Yeah.
Okay, so let's say that I potentially entered a trade over there, right? Now, we can see that price always does the same thing over and over again. So if we can see over here that on the way down, price created, there was actually an opening gap over here.
Yeah.
Okay, and we can see that inside here, this whole area actually, so from when price gapped over the weekend, there's an imbalance in price right there. So this is fair value for banks wanting to buy up that area, because we know that when price is imbalanced, fair value gap, price will want to come in there, because why? Banks want to buy to sell or sell to buy. So what they are essentially doing is when they get to a point where they want to sell, they'll push price down so they can sell it to a point so they can buy at a discount. So that is what we are seeing here, is that they are selling into a discount so that they can buy. So if you were to buy at this level, you could say that this is a fair value gap and basically mark up all fair value gaps. So although price, you can see, came here, there's another fair value gap. Price had already wicked into it. So as soon as price wicked into that fair value gap, they dropped. Why did they drop? Well, you can actually see here that here are basically some equal highs. So there's liquidity sitting there. So in a sense, you could say that this is where retail stop losses or buy stops will be, because retail traders will put a buy stop here so that when price breaches these highs, they will be taken into a buy. But what does the banks do? They will hit that point, and when price gets there, they will make a run on liquidity, making the retails get emotional and take against the trend and hit their stop losses. So what do? When they get back to fair value, they will buy it up again. So if you bought here, depending on how many pips you would want, you could set your take profit from this point to fill this fair value gap right here. So fair value is always a good point to set your take profits. If you see 4-hour fair value gap, the more fair value gap you see, the more profits you can take. So you can take maybe 2 positions or split your risk, but anywhere where you see fair value is where you want to take, because it is the least path of least resistance. So banks want to use as little money as possible to be able to take you out of the trade.
Great. Is that you or someone is trying to distract us?
No, not me.
Let's be civil, please. All right, so any question from the house? If you don't understand how to get your market directional bias, which we call IOF or institutional order flow, we have free videos already on this channel. You can go watch them up. The key thing is get a directional bias first, and thereafter, you can now use the numerous entry techniques, one of which is what we discussed today. We have also discussed fair value gap briefly in one of our videos. The title of the video is How to Patiently Wait for your Take Profits. You could go to our YouTube page channel and also look for that video. I can see 2 hands up. So I think we'll just take 3 questions, Darren, and we'll call it a wrap for today. Now, the FIB settings and the confirmations he just put up, I'll drop them on SimplyPips Telegram group. You can always pick them up. So I think we have TFX. I don't know who that is, but I'm unmuting you right now. I hope you're in a place that is not noisy. Yeah, TFX, you're muted.
Okay, thank you. But the question I wanted to ask, you have already talked about it. I mean, the FIB settings, that was what I wanted to ask you.
Okay, the FIB settings, don't worry. Yeah, we'll drop the FIB settings in SimplyPips, no problem. Afolabi.
Okay. Hello, Bishop.
Yeah, go ahead.
Mr. Darren, my question is this. Now, after doing the FIB, yeah, I could hear him very well that before you can take the trade is on 62 and 79%. That's what the area I want to clear. Am I right?
So when you pull your fibs, you'll see that on the settings. So here, I'll show you briefly the settings. So here are the settings, and your OTE is your optimal trade entry and your 62%. So this whole zone here is your sweet spot. That is your sweet spot for your trade. So when price looking for bearish or bullish movement, and when price retraces, you will want to take a trade in that zone, or you want to see price retrace and either bounce or reject from that zone. Because why do we, it's important to note that, let me just do this for you to make it more understandable. I think, Bishop, you've covered this, but it's important to know what the fibs, the point of the fibs is that when price goes up and price goes down, price will retrace. So it's important to know where will price retrace to. So if you are looking to sell, so from the top of the high to the bottom, banks will want to buy to sell. So what will they do? They will buy to sell. Okay, so the purpose of the OTE, the 79 and the 62 is to give you discount price of where price can go to so that you can get it as a discount, because you can think of it, a bank doesn't want to buy or sell at current market price. They want price to go to a certain point so they can sell it off or buy it up. So that is the mentality that the fibs can give you based on these settings we use, is where price will come to and we can expect reaction. So the OTE, the 79 and the 62 isn't enough confirmation in itself to give you a reason to take the trade. It is just another tool in your toolbox to see where price can come to where you can take a trade. Does that answer your question?
I think it does. So from 62, OT, and 79, all put together is called the sweet spot.
Yes, correct. So it depends on how much you risk per trade, but I personally never risk ever more than 2% risk per trade. So if you were seeing that price was either a bearish or a bullish move, you'd maybe want to enter between the 62 and the OTE, and then maybe another entry between the OTE and the 79. So because price doesn't always come to the OTE or always go to the 79, you will then be taken into the trade based on having two positions. So if you know you want to risk maybe 1%, then you could split your two positions into 0.5% or 1% if you're risking 2. So that is how I do it, but might not be for everyone. So maybe you only want to trade off the OTE, but you'd not use the OTE every time. You need to use other confirmations. That is the point I'm trying to get across. You need to use the institutional order flow. You need to use the order blocks.
Great, great. So I think we'll do a video very soon. We'll do maybe a webinar very soon on discount and premium. The discount and premium, we might do something around that discount and premium array. Is a concept made popular by ICT to help understand why the banks will buy at certain level and sell off at certain level. So this is a wonderful presentation, and we appreciate this knowledge shared with us. Again, let's put a 555 in the chat box to appreciate him. Yeah, someone was asking, in that case, where do you put your stop loss? I think he addressed that. You could put your stop loss at 0.100 or depending on your risk. So Darren, we really want to appreciate you for sharing this knowledge with us, and we hope.
No problem. I don't mind sharing anything I ever learned, because it can only be used for hopefully the good for everyone to profit from. And I know there's a lot of people that retail trade and they don't even know the other side of the market. And I mean, there's so much misinformation.
Especially, Darren made mention of retail trade. If you don't understand that, I think we'll create one day in SimplyPips to try to differentiate the retail trading. I'd already promised that I was going to take us through turtle soup form of trading, and we'll do that. We'll do our best, but that doesn't change the fact that every single trader has to go to the chart and either back test or forward test your strategy, so it gives you confidence to take your trade. 1 or 2 losing trades doesn't mean that the strategy isn't right. You would have losing trades. You need to stay in long enough to see your winning edge play out. So ladies and gentlemen, thank you for coming online today. We hope to have a wonderful weekend and a great trading week